I'm here at Super Return Emerging Markets 2014 with Sanjay Mistry, whose official title is the Director of Private Debt and Private Equity Fund of Funds at Mercer Investment Consulting. Sanjay, you have an incredibly broad perspective of LP attitudes to private equity in general, working with a core group of 160 clients with over $18 billion in private equity exposure. How do those clients look at emerging markets within their private equity allocations?
Sure. Within sort of the private equity space, we end up finding that actually the allocation to emerging market is very varied between different investors. The sort of desire to include the emerging market risk does vary, and the appetite for sort of moving the private equity portfolio into that space is not consistent. There's a lot of inconsistency. The investment objectives of each of those LPs can be very varied and very different. A number of LPs have started in the developed space and actually taken a view that there's sufficient reward for their risk within that part of the market. Early sort of movements within emerging markets haven't delivered in terms of the way that I guess a lot of people are looking for the risk to be compensated, and therefore their allocation has been quite low for a number.
Right.
That's on the one end. The other end of the spectrum is that we've got investors with a relatively high proportion of exposure to emerging markets, where they believe from a sort of objective perspective and sort of general sort of investment philosophy that they're prepared to accept a broader portfolio and look for specific risks to be sort of managed within their portfolio.
Yeah.
To be fair, the largest area where we have interest tends to be those investors with a strong ESG sort of angle to their sort of investment approach. We feel that actually a lot of the emerging market managers actually be very strong on the ESG grounds. They're very conscious of the environmental and social risks, and equally the governance risks within these sort of markets as well, where you take a look at the political situations or the broader macros, and you think of how they're going to be allocated in and controlled.
Is that a function of the fact that the DFIs were big investors early on, and the DFIs have instilled that ESG?
I think they've done a bit of that. I think a lot of the, I think it comes down to risk management. To be fair, in this space, you kind of want to be closer to the assets. I think it manages some of the potential fraud issues that come through. You have greater visibility and transparency, and you have the ability to control, which again, if you were to invest in emerging markets through a more developed, a traditional portfolio, whether it's a listed equity or a listed fixed income portfolio, your only ability of control and influence is to basically trade in and out of the asset, and that after a news flow event is potentially a bit too late. So at least with a private equity portfolio, you can get closer into the asset and have that conversation, get into the company, speak to the management, and take control and be more hands-on as a GP to sort of work your way through. You often also find that a lot of the emerging market assets within most of these GPs tend to have a relatively diverse angle to how they operate. Some of them are very much consumer focused. Again, scores very highly on sort of potentially, especially on an impact investing ground, because obviously you find that you get an exposure to a large population base on relatively low income, and that's one way of sort of playing the social impact angle and impact investing.
When your clients are looking at emerging markets private equity, are they focusing on it very much as part of their overall private equity portfolio, or are they looking at it from a macro perspective and saying we want 10% of our assets in emerging markets because we feel that's higher growth, and we think private equity is a good way of gaining emerging markets exposure for those reasons?
It tends to be more of a case of actually, we're looking to build a diverse private equity portfolio. We recognise that there are just different GPs with different qualities, and that's another way of diversifying their PE portfolio, rather than saying actually, look, this is an overall emerging market play within their own strategy to have emerging market exposure. There will be some organisations where that doesn't apply. Unfortunately, there isn't a one-size-fits-all approach with LPs. There is a mix in that sort of angle, but the majority are building private equity portfolios and taking the view that they're prepared to diversify that portfolio around. A lot of people still sort of regard Asia and large parts of Asia as emerging markets.
Right. How do you define it?
So they do take the view that actually, look, if I've got a 25% allocation into Asia as part of that, and I'll extend that out to include some Latin America and African investments, then actually I've got a reasonably broad exposure across emerging markets. But there are so many differences in the development of economies and private equity markets across Asia as well, that actually you can take a view as to whether some of that's developed or emerging. And I don't think LPs kind of have taken the view that actually that's the only thing they want to do. They just recognise that this fits that bucket as an alternative to the US and European landscape.
Great. Well, look, Sanjay, I'm sorry we don't have more time today, because we could talk about this for hours. Thank you for sharing your thoughts.
Problems. Thank you.